Good afternoon, and thank you for joining us for part 3 of Buying Smart, Buying Safe. Everything you've wanted to know about investing in new technology and procedures. We're going to cover the financial aspects of making your purchase. So we've covered in the first couple of sessions going about the criteria for how to select what it is that is going to be successful in the practice, and what technologies make sense or overlap with the conditions that you're looking to treat, and how to bring that in. Now we're going to look at a number of the financial aspects related, and how you make some of these decisions. I really like to think about cash flow when I'm thinking about return on investment. But the question is, how am I going to pay for this? It needs to make more money than it's going to cost me. We're in business. We need to make money as well. Part of the criteria: safety, efficacy, profitability. So we need to make money with this, but how do I pay for it? And this really changes. It creates a lot of mindset about how you think about return on investment. So let's look at it a little bit. First of all, am I ready to purchase this? Have I been doing lasers or aesthetic treatments for a while? Am I confident doing them? Do I have a patient population to support it? Or am I brand new in this? If I'm brand new in this, I may still consider rental to make sure I have a patient population, market that day. It's only, an 8-hour day when you're renting, and market that day and really fill that day up and make sure that you have what it takes to get it done. But if you've rented a few times and you have the population to support the purchase, then certainly long-term purchase will can drive lots more revenue to your practice than rental alone. So when I think about return on investment, say we have a $150,000 device and we're charging $3,000 for a series of treatments. I can think about, well, geez, I need to get 50 patients in before I make any money. So that's one way to think about it. Another is $150,000 device, $3,000 a patient. If I finance this, on a 5-year dollar out, we'll kind of look at this in part of this series, but if I finance this piece of equipment, it's going to cost me around $3,000 a month. So each patient a month would generate revenue for me. So let's say, the first month comes around and I treat 5 patients. That's $15,000 in revenue. If I perceive that I need to make at least $150,000 back on this device, day one anyway, or I look at that as my cost, or that's the cash that I shelled out from my pocket, then I'm still going to look at this and say, geez, I still have $135,000. I just treated 5 patients. I haven't made any money yet. That's really a mindset thing, and it's a hard way to live. To be able to think instead and say, geez, I have a $3,000 a month payment. I generated $15,000 in new revenue, $12,000 net cash flow. I've improved my cash flow by $12,000 this month. I'm off to a terrific start. That could free me up to, if I can make sure that cash flow stays consistent, advertise more, hire another staff person, invest in newer technology, grow my practice, look at another location, whatever it is. This is how you build up by cash flow. The investment on a piece of technology is a depreciating asset anyway. So I'm not in such a huge hurry to pay for something that probably is going to be worth about what I owe on it at the end of it, which is nothing. They're not worth much 5 or 6 years later. It's how much money can we generate with this? How much revenue can we generate with this? This is the what we're doing to be successful. And then financing in general. I want to make sure that I'm looking at, the rate, the term. Lease versus finance is still in this slide, but unless you're a larger institution looking to get all the long-term liabilities off your balance sheet, financing certainly is the way it's done now. But we want to look at these types of things. We have a terrific partner, supporter of our community in iLeaseWorks, Tony Tidlaka and his group. They are really transparent with this kind of stuff. So if you want them to review a lease, or you want to get a quote from them, I think that would be really smart to do. But you should know all of the answers to your questions. You should know exactly how much it's going to cost you, how many dollars are you putting out of pocket. That includes fees and first and last and whatever it is. You should know all that. If you have any questions remaining, you should ask before you sign anything. So now let's look at some of the criteria. 179 deduction is misunderstood and misused in a lot of cases. Let's identify what it is. 179 is accelerated depreciation. It allows us to fully deduct 100%, which normally we're on a depreciation schedule set up by the IRS. It's typically 5 years. It's not exactly 20% a year, but 5 years, and you depreciate a portion of what you've purchased each year. With the 179 deduction, you can accelerate the depreciation and depreciate 100% of that device in the given tax year. Why is this of value to me? I'm a big cash flow person. I'm a big cash on hand person. So if I'm able to keep more of my dollars in my hand, and I'm able to do it all this year rather than waiting 5 years to recapture those dollars, I want to have them today. In terms of marketing, most marketeers, people that are successful doing, and certainly digital marketing is even beyond, but $1 may be worth $5 or $6 invested well in good marketing. It could be worth 10 or 100 times in digital marketing. So to re-spend those dollars rather than letting them sit in the IRS bank accounts makes a huge, makes a lot of sense to me. In regards to how you use 179, I'll just do some simple math. If I bought something, let's say I made a $250,000 in revenue, or in take home revenue for myself through my corporation, however that is, salary, whatever, it doesn't really matter. But through the corporation, we have profit, and $250,000 profit. I buy a piece of equipment for $100,000. If I didn't buy that piece of equipment on a $250,000, say you're in the 35% tax bracket, so let's call that $80,000. You're going to have an $80,000 tax liability on your $250,000 in earnings. Now I bought a piece of equipment for $100,000 with my $250,000 in revenue. Well, I can depreciate that fully from my top line. So instead of showing the IRS that I made $250,000, now I made $150,000. $150,000 still taxed at the same 35% rate, but again, it may be in a lower rate. If you were 39.6, maybe you're in 38 now. So, but if I go same 35% on 150,000, let's call it 50,000. So I've saved $30,000 by deferring tax deduction over the next 4 years and taking it all right now. $30,000 on this $100,000 purchase. If I finance this piece of technology, now I'm paying $3,000 a month, and I've saved $30,000 right off the top. So I'm really cash ahead for the first 9, 10, 15 months of this agreement. I've actually put cash in my pocket. So it's interesting to think about that buying a piece of technology, when you're looking at cash flow, can actually produce cash flow for you. But in this case, certainly it can. This is something definitely to talk to your accountant about, but you should be using it. You should be using it every year if you're making profit and continuing to want to grow your practice. built-in dollars for marketing. This, I struggle with this because a lot of manufacturers are doing this now. It's smart of them because they want to encourage physicians to invest in the technology beyond the technology alone. If you build it, they won't come. If you just buy it and put it in your office, they won't come. That's not the way it works. You still need a market for it. So, but these dollars are your dollars. What I don't like about build and manufacturer dollars are your dollars stipulated back to you how they can be used. So I think it's a challenge when you're building these dollars in. When I look at negotiating, if I really want to get the best price, I'm going to pull all these kinds of things out to the extent that I can. And if I'm really looking to get the best price, but say, you know, a lot of these companies match dollars and do things like that. So it's interesting to look at, but again, these dollars are yours at the end of the day. If you're in an established practice, go out, take the time, take the 6 weeks when you don't need something, you're not in crisis, and establish a equipment line of credit. You know, an established practice, $250,000 equipment line of credit, it costs you $100 a year to renew it. They're really easy. They're inexpensive. Right now, I think, you know, these are probably a couple points below equipment finance rates. So very low rates, and they give you a lot of flexibility, especially when negotiating, but knowing that the dollars are there and then being able to decide whether you're going to pay in cash at the end of the year or an equipment line of credit. Whatever bank gave you that line absolutely wants to turn around and do what they call term out your loan. Then they'll loan you money. So you borrow that money on your line of credit, you wait 4 or 6 months, see how you did, what kind of distributions are going to look like and this kind of stuff. And then you decide, geez, I'm going to finance this over 3 years, 4 years, 5 years, based on how I did. You can turn around and still borrow that money from the bank. They'll pay off their own equipment line of credit and you'll turn that into a term loan. But oftentimes it's a really inexpensive way to do it. I love personally to use my credit card as much as I possibly can. And then I turn around and pay that off with the equipment line of credit, and then we'll term that out. By using the bank, by figuring out my 179 deduction, by some of the tips and tricks that we've talked about before, pooling existing patients and understanding that there's a patient population to support the purchase. All of these are tools to mitigate risk. Checking with my med-mal carrier, sending my consent form to my med-mal carrier and having them review it and getting an email back from them saying that they approve it so that I have documentation of those kinds of things. These are all tools to mitigate risk. And I think at this point, we want to look at, especially as you're newer into this process, mitigating those risks. Having a plan beyond the purchase. And in part 5 of this series, we will go through that, but having a plan beyond the purchase. How am I going to implement this? What do I need clinically? Who are my champions going to be? What kind of marketing am I going to do? How am I going to do it? How am I going to fund it? What does the first 100 days of this rollout look like? But I want to bring in a piece of equipment. I want to launch it, unroll it, and make sure that I have a plan so that it's going to be successful, because I'm dependent on this revenue to continue to build my practice and the other aspects of my practice. This annuity allows me to buy other technologies down the road. If I'm not successful with it, I lose that ability, that purchasing ability, or those dollars. And now I've used time as well. So we're really focused on having a strong plan. Lastly, let's look at negotiation strategies. to negotiate the best price, one of the things is you can use arbitrary deadlines. You know, I want to make a decision by next Wednesday. It shows that you're serious. So I'd like to have a decision made by the end of the week. Now, if you push back your deadline, you don't sign the form, whatever, you don't sign the form, but you can use those deadlines. They have created a sense of urgency for you. End of the quarter, end of the week, it's a promotion. We have one left. My manager said, because you're so special, they've created a lot of urgency. You can use that same urgency back. List price, I hate to say it, but is really become more arbitrary than ever before. 15 or 20 years ago, we were much closer to list price. There was wiggle room, sure, but for the most part, we were a fair price in the market. I've seen the same devices with $100,000 swings, where one person spends 150,000 and someone else spends 250,000. That's an incredible difference. And one of the things about our industry that I don't love anymore, and I think needs to stop, some of that is transparency through groups like Business of Aesthetics. There's other boards and groups that communicate. So I think there is more visibility to pricing now, but especially if a device is brand new in the market, it's going to come out very likely with a high list price. They'll sell a couple hundred of them at that price to the early adapters that really want to be new and have the newest and best and first in the market. And then we see considerable price drops. These oftentimes can be 30%, maybe even 40%. So they're incredible numbers. But if I was shooting for a price, I mean, in my head, my starting price is probably 20 to 30% off a list price, which I think is arbitrary in the market, especially if the device is newer. Adding on modalities is an inexpensive way for the manufacturer to bring you more value. But if you don't need it, then you don't need it. So add on, but if you can generate money and they are able to keep their price higher, but now for, let's call it $200 a month for, $5,000 more, or $400 a month for $10,000, whatever it is, cost-wise, if you can generate 3, 4, 5, 10 times those dollars, then these modalities really do make sense. Leveraging the bundling, if there's 2 devices from the same manufacturer that you want, really leveraging on the second device is another terrific way to get great pricing. Sell to the rep why you need a better price. I never understood why some physicians, they don't get it, I guess. Treat sales reps adversarially. You really want to buddy up with your sales rep. You know what they're trying to do. They're trying to sell you something, and they know what they need to do. But those physicians that really work with the rep, hey, I'm going to help you be more successful. Don't make lots of money on me. Help me make money. Help me be successful. I need you. But I've got a lot of friends and I'll reach out for you. I'll be a reference. I will. So I put some of that down. Reference sites, visits, access to the practice. You'll pick up the cell phone when they call you if they need you. These are things that absolutely resonate with your sales reps, and even more so their sales management. Warranties, typically 8 to 10% of the cost of a device now annually. So that's a lot. We're talking $10, $12, $15,000 a year in warranties. If I can extend this out 2 or 3 years, it makes a ton of sense. So much sense that if I take a 179 deduction and a 3-year warranty with a new device, even if I'm replacing something that I own already in the office, but I'm keeping that under warranty, I can actually buy a new device and either spend the same amount of money or less money with a newer device because of the if warranty and 179 are used together. But extended warranty is absolutely, I would start talking about it up front. Some manufacturers are even up to 5-year warranties. Lifetime warranty is a hoax. That means they won't exist. They're going out of business. I've never, any company I've ever heard of doing lifetime warranties is no longer around. But 3 years is 1 year is standard. 2 years, I think, is getting to be more standard. 3 years is terrific if you can negotiate it. 5 years, there's a few companies out there doing this. That's excellent to know that you have that peace of mind for that amount of time. And then lastly, do I take advantage of my own financing versus manufacturer financing? Manufacturer financing is always through a third party. I'm not aware of any manufacturer doing really, truly their own in-house financing. They're using third parties, and there's a cost to that. Having said that, if there's a 0%, XYZ program, after you've negotiated the price that you're able to take advantage of, sure, go ahead and take advantage of it. But almost always you're going to be able to secure better rates yourself. There's a lot of hidden fees in what the manufacturer offers. So the rate may look good, but again, you're looking at total out-of-pocket expense. I have a feeling you'll be able to do much better on your own. Thank you again from the BOA team. If you need our help, please get in touch with us at thebusinessofesthetics.org. I can be reached jeff@businessofesthetics.org. Good luck. Hope this has helped. Please share it with your friends. Join our Facebook or LinkedIn group. Ask questions, participate, get to know the rest of the community. Thanks very much and have a terrific rest of your week.